Hey rich friends, welcome back to my channel. In today's video, I want to talk about retirement accounts. If you just moved to the United States of America, or you just got your first job, or you live here, you grew up here, but you just got your first real job and you're beginning to think about retirement savings, this video is going to be very helpful for you. I moved to the US about 4 years ago for my MBA, and the very first 2 years, I was just in business school learning. And then I started working in the US about 2 years ago. I remember when I was sent my employment package with the different retirement accounts, I was very confused. I was like, what exactly is this? Which of these options should I invest in? How much should I invest in? What is an employer match? These are the kind of questions that I had. And I was so overwhelmed by the amount of options and amount of information out there that I actually did not sign up to anything for a while. But over time, I have educated myself, I have learned some of these things, and I'm going to be speaking as a beginner to a fellow beginner about retirement accounts. I'm going to talk about the different types of retirement savings account that you have in the United States, what they are, how to contribute in them, what are the tax implications for investing in this account, and what you can expect when you retire. And at the end of the video, I'm going to be talking about investment strategies to consider, where to invest, what to invest, strategies based on your income level and your particular employment situations. So let's get into it. There are 3 retirement accounts you need to be aware of in the United States. You have the 401k, which is an employer-sponsored plan, the traditional IRA, and the Roth IRA. Starting with the 401k. So the 401k is an employer-sponsored plan, meaning you need to be employed. Your employer has to offer 401k as part of their benefits. And this employment could be self-employment. So let's say you have a business that is registered as a corporation, as a company, you can offer yourself a 401k through that, or you are working for a regular, already established company. The 401k is a tax advantage retirement savings plan offered by employers. You make contributions into your 401k pre-tax. What that means is when you are making contributions into your 401k, the money you are contributing to your 401k is not taxed. Your money grows in the 401k tax deferred. That means you are not paying tax on growth, you are not paying tax as money is in the account, and you only pay tax in retirement when you withdraw money from this account. This is very, very beneficial because think about it this way. Let's assume that you are earning $100,000 a year and you contribute $20,000 into your 401k. First, there are many tax benefits. The first one is that your taxable income for that year will be $180,000. You will not pay tax on your full $200k income. You will only pay tax on $180,000. So firstly, the 401k reduces your tax burden every year. So if you are an high earner, you are in one of the top tax brackets and you are paying a lot in tax, by contributing to your 401k, you can reduce your taxable income. So that's the first benefit. Second benefit is the $20k that you've contributed into your 401k in that year continues to grow. So you're earning interest on $20,000. If the 401k was not a tax deferred account, what it will mean is that your $20k that you contributed into the 401k would actually be $14k. But because the 401k is a tax-deferred savings plan, your 20k is 20k in your 401k and you are earning interest on 20k. You continue to earn the compound interest on that 20k until you retire. So that's the second benefit, is this account is tax-deferred. You don't pay tax on your capital gains. You don't pay tax on the interest that you earn. You don't pay tax on the money. Essentially, it's tax-free. Now, when you retire, you pay tax on your withdrawal. Now, this is also a tax advantage because for many people, like for the average person, by the time you retire, you would be in a low income bracket. So your income bracket is based on your annual income. And when you're in your 20s, 30s, 40s, depending on where you work and what you do, you probably are in a high income bracket, like above 30%, 37% or something like that. But when you retire, and you essentially have zero income, or maybe you have something small like 50k or 100k as your regular income, the average person will be in a lower tax bracket when they retire. Now, what this means is you are paying a lower amount of tax on your withdrawals for your 401k. So let's say you are contributing to your 401k now, and your actual tax rate right now is 33%. As you continue to grow in your career, maybe your tax rate goes as high as 37% or even 40%. By the time you are withdrawing from your account, you may be paying, you may be at the lowest income bracket, and you may be paying, that tax rate on your withdrawals. So there are many benefits, there are many tax benefits, both now and in the future, for contributing into your 401k. Not all good things come free. There are limits to how much you can contribute into your 401k every year, and those limits change on a year-to-year basis. But in 2025, the contribution limit for a 401k is $23,500. So that means that the maximum amount of money that you can contribute into your 401k is $23,500. If you are above 50, you can contribute a maximum of $34,750 into your 401k in 2025. Some employers offer some type of benefit that they call the employer match. The employer match basically is when your employer matches your contribution into your 401k. And the match that your employer makes into your 401k ranges, and it differs from employer to employer. Some employers may match 5% of your contribution. Some may match 10%. Some may just put money into your 401k without you even contributing. Yes, I know of some employers that do that. This is a very important benefit because it's known as free money, essentially. And this is part of your benefits in that job. So figure out if your employer offers an employer match, definitely, contribute something into your 401k so that you can get the employer match. But if you don't know, this is something that you need to figure out and ask your human resource HR department as soon as possible. In retirement, your withdrawals from your 401k are taxed as ordinary income. So they are taxed at the tax bracket or tax rate that you fall into at retirement. And if you need to withdraw money from your 401k before you retire, so this is called early withdrawals, right? If you want to withdraw from your 401k before the age of 59 and a half, you will face a 10% penalty on your withdrawals, unless you qualify for an exemption. So let's say that you are 40 years old and you have money in your 401k and you want to buy a house, and you need like extra 20k to make up your down payment, and you decide to withdraw the 20k from your 401k, you will be subject to a 10% penalty. So you will be subject to pay, $2,000 of that money to the 401k authorities. The second type of retirement savings account is the traditional IRA. So IRA stands for Individual Retirement Account. As the name implies, you can open a traditional IRA by yourself. You do not need your employer to have a traditional IRA. It is a regular retirement savings account that you can open by yourself. Now, the tax benefits for the traditional IRA differ from the 401k in the sense that your contributions into your traditional IRA are tax deductible. What that means is you pay tax on whatever you contribute into your, traditional IRA. And you pay that tax at your regular income, your regular tax rate right now. So if you're at a 33% tax rate, you pay 33% tax on the amount of money that you contribute into a traditional IRA. But similar to the 401k, any money that you put into a traditional IRA grows tax deferred. So from when you put the money into the IRA and when you withdraw it, you are not paying tax on that money. There's a contribution limit of $7,000 every year. If you're above 50, the contribution limit is $8,000. So you can see that, it's a little bit more limited than the 401k. In retirement, withdrawals from this traditional IRA are taxed as ordinary income. So you pay tax on your withdrawals at the tax rate that you are in retirement. And similarly to the 401k, if you need to withdraw money from your IRA before retirement, you'll be subject to a 10% penalty fee. Traditional IRA still has tax benefits. When you compare the tax bracket that you are in now with the tax bracket that you will be in retirement, as I said earlier, the average person will be in a much lower tax bracket in retirement than they are at the peak of their career the tax differential is the tax benefit. So let's say right now you are subject to a 33% tax rate, but in retirement you're subject to a lower tax rate, so 20% or 10%. You reap the reward of that tax differential. Now, moving on to the third type of retirement savings account. This is the Roth IRA. The Roth IRA is a type of IRA where you contribute your money after tax, but when you withdraw the money tax-free. Tax-free, no tax on withdrawals from a Roth IRA. So when you are contributing the money to the Roth IRA today, you would pay tax on that money, but your money will grow in the Roth IRA tax-free. So if you contribute the money right now, from when you put the money in till you withdraw it, you are not going to pay any tax on that money. Doesn't it sound amazing? It does sound amazing. This is the major tax benefits from this Roth IRA. Similar to the IRA, the contribution limit on the Roth IRA is $7,000. And if you're above 50, the contribution limit is $8,000. So you put money into the account, and by the time you are retiring, you withdraw from that money tax-free. However, because it would be too good to be true if everyone could do it, there are income limits to the Roth IRA. So if your annual income is above $161,000, you are not able to contribute into the Roth IRA directly. You will have to use something known as the backdoor Roth IRA strategy to be able to contribute into a Roth IRA. Basically, you have to take the backdoor to contribute into a Roth IRA. So if you are a high earner, you are earning above $161,000 on an annual basis, you are not allowed to contribute directly into a Roth IRA, which is why the Roth IRA is amazing if you are just starting out. If you are just beginning your career, you got your first job, you are still earning below $161,000, you can contribute into the Roth IRA now, and by the time, and the money will grow tax-free, compound interest over decades, and by the time you are retiring, you get the money out of that account without paying tax. Another amazing thing about the Roth IRA is that you can withdraw your money at any time without penalties. So it's almost like a savings account, essentially. You can withdraw your contributions, not your earnings, at any time without penalties. It's a pretty good option, if you ask me. Which brings us to the last part of this video, which is investment strategies. With these three options, how should you invest? Step 1, if your employer offers an employer match, that means they will match your contribution into your 401k up to a particular limit. Then the first investment strategy is for you to invest enough to get the employer match. Some employers will have something like, you need to invest at least maybe 10K, at least 20K to get the employer match. So figure out if your employer has an employer match, and figure out what is the minimum amount of money you need to contribute into your 401k to get the employer match. Once you figure that out, the first investment strategy is invest enough in your 401k to get the employer match, because this is essentially free money and it's part of your benefits in that job. Step 2, consider a Roth IRA. Yes, if you are in a lower income level, so below $161,000, the Roth IRA is a better investment strategy than the traditional IRA, because your money grows tax-free and you can withdraw money from your Roth IRA tax-free as well. If you also expect to be in a higher tax bracket, starting to invest in your Roth IRA right now is the best thing you can do. So for example, let's say you are in investment banking, but you just started your investment banking job, so you are still earning like 70K, 80K, 120K. Perfect. You are in investment banking, consulting, careers that typically your income grows as you grow in that career. And as your income grows, you'll be in a higher tax bracket. Immediately you start the job and you are in a lower tax bracket, this is the best time for you to invest in the Roth IRA. So start now, ASAP, 7K a year, just put the money in there. Like your bonus, your first paycheck, just contribute 7K into your Roth IRA and call it done. Once you've done those two, the next step is to max out a traditional IRA and or your 401k. After you've maxed out your Roth IRA, start contributing to your 401k, especially if you are in a high tax bracket now. If you are in a high tax bracket now, investing in the 401k makes so much sense, because by the time you retire, you should be paying tax at a lower tax rate. If your employer does not offer an employer match, max out the traditional IRA first and then invest in your 401k. And then the last bit is, when you put this money into the savings account, you are allowed to choose where to invest. So you're allowed to choose like the basket of securities where you want your money to be invested in. This is important because just putting money in a 401k, just putting money in a Roth IRA or an IRA is just the first step. The next step is for that money to grow, right? And your money could grow at 1%, it could grow at 10%, it could grow at different rates. And you have the opportunity to kind of shape how fast or slow your money grows by choosing the basket of securities in which your money are invested in seriously. My recommendation is index funds. These are things I invest in, like the S&P 500, the total stock market index, right? This S&P 500 over time has been shown to have a high rate of returns. There are some actively managed funds, different investment strategies that do not even match the long-term rate of return of the S&P 500. So without breaking your head and thinking about, oh, should I invest in this stock or this other stock, just putting your money in an index fund targeting the S&P 500 is a good enough strategy to begin with. The benefits of this are, number one, it is low cost. So you're not paying a lot of money from your 401k for an investment manager to be actively trading your 401k. And secondly, it is diversified. The S&P 500 is a basket of stocks, from different industry. So this gives you diversification. If negative news comes up and impacts, let's say, tech stocks, you are not going to be adversely affected because there are other stocks in the same basket that will not be as affected as tech stocks. So investing in a diversified portfolio helps to protect you from the up and downs of the stock market. And this is what you need when you are thinking of a long-term investment strategy. If you're in your 20s now, you probably will not retire for the next 40 years. So investing in a fund, in a basket of securities that have long-term high rate of return is the best thing that you can do. Another type of funds that you can invest in are called target date funds. So these funds automatically balance your portfolio based on your age and when you plan to retire. There's an investment strategy that says that, for example, when you're younger and you can take more risk with your money, you should invest in things like stocks. Whereas as you get older and your risk level is dropping, you should invest in things like bonds or money market securities because they have low risk. So these target date funds automatically balance your portfolio as you get closer to retirement. So if you are 20 right now, the fund will automatically invest in things that have high return but are also high risk. So you have risk of losing money, but if the thing goes well, you also have a higher probability of earning a lot on the money. And then as you grow older, the funds will also automatically withdraw you from some of those higher risk investments and begin to invest your money more in the lower risk, low to medium risk type of assets. These are two options that, as a beginner, it's just safe for you to put your money in there and forget about it. So to recap, you have a low income now, but you expect to earn more later. Start with a Roth IRA and then max out your Roth IRA and then 401k. If you're in a high income now and you expect a lower tax rate in retirement, then max out your 401k. If your employer offers good 401k match, then contribute into your 401k enough to get the match. If you do not have an employer-sponsored retirement plan, then start with either a traditional or a Roth IRA. Contributing to your Roth IRA requires discipline in making sure that you are not falling into lifestyle creep and you are saving enough money both for now and in the future. And that's why having a financial plan is very, very helpful for you. I have a video here about how to create a financial plan for 2025. I want you to go and watch that. So this is a high-level roadmap. If you follow this roadmap, you set yourself up to build wealth while maximizing your tax benefits. Let me know if you have any other questions on retirement savings account in the United States for beginners, and I'll be happy to make a follow-on video for you. Thank you for watching my video. I'll see you in the next one. Until then, stay rich and build wealth. Bye.